The silver price is lying in plain sight, and the spread is the one thing the market can fake forever. Because the real fight right now isn't bulls versus bears, it's the physical pipeline versus the paper machine, and the paper machine is trying to convince you nothing is wrong while it quietly scrambles for deliverable metal. That's the conflict. And here was the part most people miss. The market doesn't want to run out of all silver or sunny oil first. It runs out of deliverable silver that can actually be sourced, financed, and moved on the calendar that matters. That's the hidden detail that changes how you read every headline and every candle. Stay with me, because by the end, you'll have a clean, concrete checklist for the next 1 to 2 weeks. What levels matter? What confirms the thesis? What breaks it? And the one pressure gauge that flips this from volatile rally into structural squeeze. And yes, it can still whip around violently, even if the thesis is right. That's not a disclaimer. That's the weapon the market will use against you. Now look at what just happened. Silver didn't grind higher. It exploded into year-end, printed a record spike, and then it got hit with a brutal intraday slam, double-digit in some venues, because the market did what it always does when it's crowded and the leverage is hot. It yanked the leash with margin and forced people to sell first and think later. That's not a conspiracy, that's plumbing. A margin hike is a lever that instantly changes who is allowed to hold a position, how much cash they must post, and how fast weak hands get liquidated. And right into the end of December, thin liquidity, risk managers on high alert, funds cleaning books, index rebalances looming. The timing is not random. This is exactly when a tight market gets loud, because the calendar compresses choices. But that's not the part that matters. The part that matters is what the physical market is saying underneath the noise, and why the paper print can be down while the system is still tightening. Because in silver, you're not trading one market. You're trading at least 3 different silvers, and they don't clear at the same price. There's the headline spot price. People quote like it's the truth. There's the futures curve where leverage and hedging dominate and where price discovery is supposed to happen. And then there's the deliverable, financeable, movable metal, specific bars, specific specs, specific locations, where real-world frictions show up as delays, higher leasing costs, wider premiums, and a scramble for the right kind of inventory at the right time. And when those diverge, the paper price becomes more like a scoreboard than a supply signal. You can watch the scoreboard flash red and still be watching a game where the other team is running out of players. And that's where the real pressure starts. Here's the hidden detail cleanly stated. The system can look well-stocked and still behave like it's scarce, because what matters is not total silver exists, it's how much silver is actually available for delivery or lease without causing someone pain. That's why the inventory conversation is always confused. People see a big number in a vault report and think, problem solved. But silver inventory isn't a single pile, it's categories. In the futures delivery ecosystem, there's metal that meets specifications and sits in approved warehouses, and then there's the slice of that metal that is actually tagged as deliverable against contracts right now. Those are not the same. Eligible metal can be there, but not for you. Not at your price, not on your timeline, not without someone choosing to reclassify it, lend it, or sell it. Registered or deliverable metal is the one that matters when delivery pressure rises. Because when delivery demand surges, the market stops being a betting venue and turns into a logistics and financing problem. And once you see that, you stop reacting like a tourist to every intraday smash. You start reading the pressure gauges. Now, let's talk about why delivery pressure is the quiet engine here. Futures contracts are often treated like paper chips, and most get rolled or cash settled through normal behavior. But silver is one of those metals where delivery can become a live wire when the incentives line up. Especially when price rises fast, when supply fears hit at the same time, and when investors decide they don't just want exposure, they want metal. Delivery is where paper has to face bar. It's where the system has to prove it can settle. And when delivery activity runs hot through a month, it's telling you something. Either someone really wants physical, or someone is using delivery to secure supply, or someone is pulling bars into controlled channels where they can't be easily rehypothecated. And the next detail is what flips the whole setup. The market can meet delivery in the short run while still becoming tighter, because meeting delivery doesn't necessarily mean new supply arrived. Often it means existing inventory got reassigned. That's a shell game that works, until it doesn't, and you don't need drama to understand it. Think like a warehouse manager and a risk manager. If deliverable stocks get drawn down or become heavily spoken for, the system becomes more sensitive to shocks. That sensitivity shows up in spreads, lease rates, and volatility long before it shows up in the headline price. The paper price can even be pushed down violently on margin events, like we just saw, and the physical tension can remain, or even worsen, because margin liquidation is about leveraged paper holders, not about industrial users suddenly canceling procurement. And that's why the paper price can be the lie while the structure tells the truth. So what do we use as proof, not vibes? We stack it. Mechanism first, a tight physical market expresses itself through the cost of time and the cost of borrowing metal. That's term structure and lease. When the market is comfortable, future delivery is priced above spot. Classic contango, because storage and financing costs exist and nobody's desperate. When the market is stressed, you start seeing the nearby part of the curve get bid because people want metal now, not later. That's backwardation risk, or at minimum a flattening that screams immediacy. It's the market saying time is expensive. Then we look for institutional behavior that matches the mechanism. One of the biggest institutional wrappers in silver is the iShares Silver Trust. It's a real-world warehouse of metal tied to investor demand, and its own published data shows the ounces in trust at roughly 526. 9 million ounces as of late December. That's not a vibe. That's an enormous, concentrated pool of metal that exists because investors want exposure through a vehicle. And here's the catch. Most people cannot redeem that silver for bars. Only authorized participants can create or redeem baskets. So if the trust grows, it can pull metal into a structure that tightens availability for everyone else, while retail investors feel like they own silver without being able to touch it. Convenient for portfolios, potentially stressful for the pipeline. And that's where the real pressure starts, because the easiest way for the system to absorb demand is to warehouse it inside institutional wrappers, not to magically increase mine supply. Next proof point, London. London is a settlement backbone for a huge amount of wholesale precious metal activity, and the vault data matters because it shows the size of the pool sitting inside that ecosystem. As of the end of November, London vaults reported silver holdings around 27,187 tons. On its face, that can look like plenty. But here's the trap. A big pool doesn't guarantee a liquid pool. Leasing supply can tighten even while headline holdings rise because metal can be held for specific owners, for specific purposes, with specific constraints. The market can be full and illiquid at the same time. And when that happens, the price you see becomes less about abundance and more about who is willing to lend, at what rate, under what terms, on what timeline. Which brings us to lease rates. When physical demand reduces the pool of available leasable material, especially in London, lease rates can spike. That's not a rumor. It's the basic economics of borrowing metal. If you're short and you need metal to make good, or you're an industrial user trying to secure supply and fewer holders are willing to lend, the cost goes up. Elevated lease rates are a symptom. They're a heat map. They don't prove the world is out of silver, but they do tell you the immediate borrowable float is tighter than the headlines suggest. And that's not the part that matters. The part that matters is what that forces participants to do. Higher lease rates and tighter immediate supply don't just feel bullish. They change behavior. They make shorts more expensive to maintain. They push traders toward covering. They make rolling positions harder. They pressure market makers who need to stay hedged. They raise the odds that a move becomes self-reinforcing in bursts. Which brings us to the reflexivity engine most people ignore, options. Silver options are not just side entertainment. They can become a forced buyer mechanism when volatility surges and price is moving fast. Here's the clean version. Options dealers often hedge their exposure dynamically. When price rises and call options get more sensitive, dealers may need to buy futures to hedge. The buying can accelerate the move. If price then snaps lower, hedges can unwind and selling can accelerate. It's not personal, it's math. And when implied volatility is extremely elevated, late December readings on the Silver Implied Volatility Index have been in the kind of territory you don't see in sleepy markets. The hedging flows can turn price into a pinball machine. That SY, you can get a record spike and then a violent drop in the same breath. But volatility doesn't invalidate the setup. It's the delivery mechanism's way of shaking out leverage. It's how the market extracts payment from conviction. And that's why retail gets emotionally destroyed in silver. They confuse violence with direction. They treat every smash as it's over and every rip as it can't stop, and they get chopped into dust. Volatility's job is to separate you from your plan. But that's not the part that matters. The part that matters is the calendar. The why now trigger is real, and it's sitting right in front of you. Year end. Year end means liquidity thins. It means funds rebalance. It means risk desks tighten. It means margin sensitivity is at maximum. It means the market is more likely to gap, to air pocket, to overshoot. And it also means you re-approaching a new year with fresh catalysts layered on top. Policy changes hitting January 1st, commodity index rebalancing early January, and a market already stretched and crowded. That's not a prediction, that's a setup for volatility. When you combine a tight physical story with end-of-year positioning, you get exactly what we just saw. A move that looks too big, a narrative that looks too obvious, and then a violent reset that makes people abandon the trade right before the next impulse. And the next detail is what flips the whole setup. The margin hike event itself can be interpreted as a stress signal. Exchanges raise margins when volatility rises and risk increases. That's risk management. But it also acts like a circuit breaker that forces leveraged participants to reduce, which means the players most likely to get flushed are the ones least able to take delivery or hold physical paper longs using leverage. When they puke, the paper price drops. Meanwhile, the structural forces, industrial demand, strategic procurement, supply constraints, don't suddenly disappear. They keep grinding. That gap between paper-forced selling and physical steady demand is where the lie can live. Now add a second catalyst: export restrictions and supply chain policy risk. When a major refining and export node hints at tighter controls, markets don't wait for perfect data. They front-run the risk. They pull forward demand. They hoard optionality. Industrial consumers don't like being surprised. They'd rather pay a higher price today than face a production stoppage later. And silver isn't a cute collectible to them. It's a component. It's a conductive input. It's part of electrification, solar cells, EVs, and the build-out of data centers. That matters because industrial demand is often price inelastic in the short run. If the alternative is losing market share or missing delivery, they source the input. They don't debate your chart. They buy. That why the industrial bid can turn a tight market into a panic market with frightening speed once the system senses a bottleneck. But here's the catch: supply can't respond quickly. Silver supply doesn't behave like shale oil where you crank a spigot. A large portion of mined silver production is a byproduct of mining other metals. That means even if silver's price spikes, you don't instantly get more supply, unless the primary metal's iron production rises and the refining chain expands. Refining and logistics have lead times. Assay, bar production, transport, insurance, vaulting. None of it is instant. Recycling helps, but it's not a magic tap you open overnight, especially at scale and in the right forms. So when demand surges on a calendar trigger, supply can't sprint, it limps. And the market expresses that mismatch not in a polite trend, but in spasms. Bursts up, smashes down, spreads screaming, volatility elevated, and every participant becoming more defensive. And that's where the real pressure starts. Now let yes address the strongest counterpoint before it blindsides you. A market can feel scarce and still crash if positioning gets too one-sided. In fact, the faster silver rises, the more it invites exactly the kind of generational bubble art language that can become a self-fulfilling excuse for a reset. Profit-taking is real. Margin-induced liquidation is real. Funds rebalancing into year-end is real. If everyone piles into the same trade with leverage, the exchange doesn't need a villain to produce a crash. It just needs math. And if policy headlines shift, or if risk assets wobble, or if liquidity disappears for a day, silver can drop in a way that feels like betrayal. That doesn't mean the physical story is fake. It means the paper channel is a weapon. And silver, more than most assets, is designed to punish impatience. So if you're going to engage with this, you need a two-scenario lens. Not because we're trying to sound balanced, but because it's the only way to stay rational when the candles turn violent. Scenario 1 is the controlled pullback and retest. In this scenario, the market digests the record spike, shakes out leverage after margin changes, and then retests key zones, areas like the mid-70s region and the psychological round number zones that were just fought over, before attempting another leg higher. Confirmation in that scenario is not price goes straight up. Confirmation is that dips find bids above prior breakout areas, that sell-offs fail to accelerate once the forced liquidation ends, and that the pressure gauges, delivery behavior, institutional holdings, term structure, leasing stress, stay firm even as price churns. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't grant a tidy pullback because the physical pipeline tightens faster than paper can suppress it, and because options, hedging, and short covering become mechanical fuel. Confirmation here is a fast reclaim of the post-smash levels, a refusal to stay below key psychological zones, and a renewed spike in volatility as the market gaps in thin liquidity. The risk in this scenario is gap risk both ways. It can rip while you're asleep. It can also smash on another risk control move. That's the cost of playing in a market where the plumbing is stressed. And the next detail is what flips the whole setup. Both scenarios can coexist in the same week. You can get a controlled retest during the day and a squeeze impulse in the overnight session. That's not exaggeration. That's exactly how thin liquidity plus leverage behaves. So the question becomes, what do you watch that cuts through noise? First, watch the calendar. The first days of January matter because of how funds and indices adjust. Early January commodity index rebalancing can shift flows and size, and in markets already stretched, those flows can exaggerate moves. Second, watch margin and volatility. When implied volatility is elevated, small moves force big hedging adjustments. If volatility stays high, the market remains fragile and explosive. Third, watch the difference between inventory exists and inventory is available. You don't need exact numbers to understand this. You need direction and category shifts. If deliverable categories trend down, or if delivery demand stays unusually persistent, that's pressure. If deliverable categories stabilize while eligible rises, that can be a sign of metal being held but not offered, also pressure. If everything rises and spreads relax, pressure eases. Fourth, watch institutional metal concentration. When big trusts publish ounces in trust north of 500 million ounces, that's not a footnote. It's a map of where metal is sitting. If ounces rise, it implies net creation and demand pulling metal into the wrapper. If ounces fall, it can imply redemption or shifting demand. Neither is automatically bullish or bearish in isolation, but the direction tells you where the vacuum is pointed. Fifth, watch London Vault trends and leasing stress as a temperature gauge. A vault can be heavy while the leasing pool tightens. If leasing stress remains elevated, it suggests immediate metal is valued. And that matters this week because immediate metal being valued is exactly what turns a paper market into a delivery-sensitive market. Sixth, watch spreads and the front end of the curve. If the near months remain bid relative to deferred months, it's the market paying up for time. If the curve relaxes into comfortable contango and stays there, that's the system exhaling. Now let's talk about key levels without pretending we have a crystal ball. You just watched silver spike into the 80s and then slam back into the mid-70s in the same session. That means the market just defined a battlefield. The upper extreme, the record spike zone, is the if reclaimed the math changes region, because it tells you the market can absorb selling and still push into new air. The mid-70s region becomes the immediate decision zone, because it's where the post-smash price discovery tries to stabilize. Below that, the next band down, the prior breakout area from earlier in the run, becomes the line where the narrative gets tested. If price falls back through those prior breakout areas and cannot reclaim them quickly, it doesn't automatically kill the long-term story, but it does weaken the near-term squeeze thesis. That asks your invalidation logic for the right now time frame. Not silver must go up, but silver must hold key reclaimed structure, or the market is telling you the unwind is still in progress. And this is where viewers usually sabotage themselves. They anchor to the top tick. They anchor to the narrative. They anchor to someone's loud target. Then the market drops 5, 8, 10%, and they interpret pain as information. That's backwards. Pain is not information. Pain is a mechanism the market uses to extract bad positioning. Your job is to separate signal from noise. Signal is structural. Delivery pressure, persistent leasing stress, curve behavior, concentrated institutional holdings, supply chain constraints, and industrial procurement that doesn't blink. Noise is the intraday smash caused by margin hikes, thin liquidity, and leverage being forced out. Both move price. Only one tells you what the system is becoming. And that's not the part that matters. The part that matters is how you keep your mind intact while the market tries to hijack it. Here's the viewer psychology shield, and it's not negotiable. First, expect violence. If you need smoothness to stay rational, silver will break you. Second, decide what time frame you're operating on before you look at the candle. If you're trading the next week, your invalidation is structural levels and near-term confirmations. If you're watching the macro pipeline story, your invalidation is different. Spreads relaxing for months, leasing stress evaporating, inventories becoming comfortably available, industrial demand collapsing. Don't mix those. Third, understand the emotional manipulation sequence the market uses. It rips hard to trigger FOMO. Then it smashes hard to trigger regret. Then it grinds sideways to trigger boredom. Then it moves again without you. This is how volatility steals both your money and your attention. You beat it by pre-committing to what you watch and what you ignore. Fourth, do not confuse a sharp pullback with the story is dead. In leveraged markets, pullbacks are often the mechanism that reloads the next move because they force weak hands out and reset dealer positioning. But also, be honest, pullbacks can be the start of a larger unwind. That's why you track confirmations, not feelings. Fifth, never let a single data point hypnotize you. Silver is a proof stack market. You want multiple independent signals pointing the same way. The curve, the borrowing cost, the delivery behavior, the institutional metal concentration, the policy risk, and the supply chain reality. If you only have one, you have a story. If you have 5, you have a setup. And that's where the real pressure starts. Now put it all together into the near-term roadmap. Over the next 1 to 2 weeks, watch for 3 things that would confirm the paper price is the lie thesis in a tradable sense. 1, stabilization above the key post-smash decision zone with fast rejection of deeper dips, meaning sellers can't keep pressing without new forced liquidation. 2, continued signs of immediate tightness, curve behavior that stays firm at the front end and leasing stress that doesn't collapse, because that means the physical timeline is still valued. 3, institutional and procurement behavior that doesn't flinch. No sudden evidence that the demand impulse is vanishing. If those hold, the market is basically telling you the smash was a leverage purge, not a structural reversal. Now, what weakens the thesis? 1. A sustained failure to reclaim and hold key reclaimed structure after the margin shock, with price slipping back into prior ranges and staying there, meaning the market is digesting for longer and the squeeze impulse is delayed or denied. 2. Visible relaxation in the signs of immediacy, front-end curve easing, leasing stress cooling, delivery pressure fading, meaning the system found supply or demand backed off. 3. Policy headlines. Reversing the shock or risk-off conditions, forcing broad liquidation across commodities, because correlation can temporarily override microstructure. Those would not prove silver is abundant, but they would tell you the next 2 weeks are not the moment. And that's the only honest way to do this without turning it into hype. Because even if you're right on the macro, you can still be wrong on the path. And the path is where most people die. Now, the payoff I promised, the one metric everyone must watch so you don't get hypnotized by the paper print, is simple. Watch the price of time and the price of borrowing. In normal markets, time is cheap and borrowing is boring. In stressed markets, time gets expensive and borrowing gets loud. That's spreads and lease. The paper price can be slammed in a day with margin and liquidation, but if time stays expensive, if the market keeps bidding for immediacy, then the structure is telling you the physical pipeline remains tight. That's how you know the paper print is a headline and not the whole story. And if that one pressure gauge flips, if time suddenly becomes cheap again and borrowing costs relax, then you know the system exhaled, even if the price is still high. That's the reframe. That's how you stop being traded by the narrative. Now I'll leave you with the only stance that works in silver right now. Don't worship the top. Don't fear the smash. Track the pressure. Respect the calendar. Assume volatility will be used against you. Keep a 2-scenario lens. Either a controlled pullback and retest that reloads the trend, or a continuation squeeze that gaps in thin liquidity and punishes hesitation. Your job is not to predict the next tick. Your job is to recognize which scenario is being confirmed in real time, and to know exactly what would invalidate it so you don't rationalize pain. If you're the kind of investor who wants mechanisms, not bedtime stories, you're already ahead, because silver is the market that rewards people who watch the plumbing while everyone else argues about the headline.